Hello, thank you for joining us. We are pleased to present the Midyear Outlook, and we are delighted to have Ryan Detrick join us today. I'm Margie Cosmero. We have Liz with us, and we're going to jump into the session. I wanted to give a shout out to clients that have been with us a long time, clients who are new to Blue Heron Financial Group. We want to send out a special thank you to the Northrop Grumman Federal Credit Union for helping to host. And I want to give a shout out to this being our 24th anniversary with LPL. It's crazy how much time has flown by. So a lot as always going on. And with that, Liz, you want to get us kicked off?
Yes, thank you all so much for joining. I just want to introduce Ryan, our special guest. So as Ryan is Senior Vice President and Chief Market Strategist with LPL. He's also part of the LPL Financial Research Tactical Asset Allocation Committee, which makes him responsible for directly impacting portfolios, decision-making process, as well as a member of the Market Insights team, developing and articulating equity and general market strategy. In this role, he's frequent presenter, thankfully, to clients like you all on the line. And you can also find him on big TV screens too. And also industry peers. Prior to LPL, Ryan built his market knowledge and solid analytical skills. He was a senior portfolio manager at Harbour RIA, managing sector asset allocation and strategy for high net worth client portfolios. And then prior to that, he spent a decade at Schaefer's Investment Research. His research and market analytics utilized technical, fundamental, and sentimental, don't listen to me, sentiment methodologies with a focus on market expectations and advanced option strategies. During his tenure there, he was the company's primary spokesperson, kind of like he is with LPL, and widely quoted on national media outlets, including appearances on business TV, radio programs such as CNBC, Bloomberg TV, and Fox Business. So Ryan might be familiar to some of you. He got his bachelor's in finance from Xavier and his MBA from Miami University. So we're super grateful to have you, Ryan. Thank you so much for joining. And I'll let you take it from here.
Oh, that's awesome. Well, thank you very much, Liz, and thank you, Margie. Margie, you mentioned anniversaries. Congratulations, 24 years. There's another anniversary in the house today. I didn't even realize it. Saw it on Facebook. I should have known, but my wife and my first date was 17 years ago today. So I love those reminders on Facebook. Like I said, last year I probably should put something on Facebook. 17 years anyway. So yeah, 17 years ago today. Where does the time go? 3 kids and a lot of stuff. A lot of
sleepless nights.
Yeah.
Congratulations.
So guys, I'm so delighted you had me here today. I know we've got, ballpark about an hour. I'll talk for a while. I know, Margie, you said you maybe wanted to start with just a couple of the bigger questions you guys have, you've received from your clients, and I can answer some. And believe me, I'm probably going to get into it a little in the presentation too. But if you want to start off with a couple of questions you've been hearing, maybe let's do that.
Yeah, that'd be great. Thanks. And, there's always these themes year in, year out. And Liz and I just are always cognizant of what those reoccurring questions are or themes. And again, we'll get into more detail on this. But some of those I'll throw out are we looking at those late 1970s inflation kind of, is this the world we're going to be in? And, I will admit to have living it back in the day and all that went with it, high mortgages and all that. And then along sort of similar, the same lines, there's always this political posture that clients sometimes want to take in weighing in on investment decisions. And Liz and I always take that ground of, look, we may or may not agree with you, but when it comes to investing, we're agnostic. And we need to, yes, pay heed to what the tax picture may look like. So I'd say those are 2 big ones, inflation, taxes, and then the last, is this market ever going to stop? Are really trees this time going to grow without stopping?
Well, maybe I'll answer the first two, and maybe believe me, all these are in here, so I've got some slides on it. But I'll go to the first two. The third one maybe add some suspense. Like maybe not. Spoiler alert: we do think it's still a bull market. I'm going to get into why we think it's a bull market. Clearly, we've got 100% rally on the S&P since the lows. Haven't had a 5% correction since last October. I think the word I use is we've been very spoiled as investors. Fortunately, it's been a very lucrative time, one of the best times ever, honestly, to be involved in stocks. I mean, the S&P 500 has made 51 new all-time highs this year already. What in the world does that mean? Guys, only twice in history, 64 and 95, has the S&P made 50 or more all-time highs before August is over. So up about 20%. I think we're down a tad today. I've been running around on meetings. So the stock's down a tad today, but still about 20% for the year. So we think, you know, if there's a dip, which would be perfectly normal, a dip would be, let's say, 4 to 8% on S&P 500 pullback. After 100% rally, be perfectly normal, and we'd use an opportunity. And I'll definitely dive more into that. But let's get into inflation, because clearly, you go to the gas station, right? $3, at least $3 a gallon. You get a gallon of milk, it's like $5. I mean, there is no doubt about it. Inflation's happening. Now the question to us is, you know, is it a surprise, right? Is the market going to be surprised by higher inflation? I want to show what I've got on the screen right now, actually, one of the slides. Barron's a couple of months ago had this cover story called the I word. That was in, let's see, that was in May, when the April CPI number, that's consumer price index, pretty much what consumers are paying for things, came in really, really hot. Now, the truth again is we think, you know, higher inflation makes some sense, right? We're coming off of the worst recession in our lifetime. Year over year, obviously we were virtually shut down, you know, last spring and started to open up a little bit in the summer. So those year over year comparisons are there, but let's just talk real world. What do we know? Well, everything's shut down, right? I've got a hot tub, all right? I need a hot tub cover, guys. It leaks because it rains and it leaks. 22 weeks to wait on my hot tub cover. I didn't have ice for like 6 months because you can't get the parts. And I know all of us are experiencing something like this because of the supply chain issues, the material issues that are out there. There's no question about it. That's a big portion of why prices are higher. Trust me. I'd pay an extra $100 if someone had a hot tub cover that I could get sooner than before the Super Bowl. I mean, you know, that's kind of how it works. But again, is the market going to be surprised by higher inflation? We don't think so, because everyone's talking about it. When you have some free time, go to Google Trends, type in the word inflation. It's how often people are searching for certain words. Massive spike higher, not surprisingly, massive spike higher in April and May when we started seeing some of these higher numbers. The stock market is smarter than any of us. Kind of, I'll get into the election stuff and the breakdown of Congress and presidents with the stock market, but the stock market's smarter than any of us. So we think it's likely that this higher inflation we are seeing, the market has already sniffed it out. I mean, literally we're making new highs, right? But again, that's your investments. But what about when you're paying for things? And I'll get to where we think inflation's going in a second. But look on the right of your screen. That was 2 years ago. I like to think that little guy's taking a nap. I don't know if that's what Business Week is trying to do, but it says, is inflation dead? By the time these things are all over magazine covers, that was actually probably one of the lowest times for inflation, and inflation took off for a couple of years. Right now, we're talking about the highest inflation we've seen in decades, literally. So it's kind of out there. So you got to be aware of that. Now, one other thing about all of this, and we wrote about this just in our weekly market commentary this week, because it's a very popular concept. The idea of, is this going to be a 1970s style inflation? I know a lot of you might remember the 70s. Like you said there, high inflation, high unemployment, relatively low economic growth. I guess I'll say the good news, assuming we're right, the good news is we don't see that at all. There's something called the misery index, and you can see it here. And that is just simply adding up inflation plus the unemployment rate. And you can see that's averaged about 10 going back almost 50 some years there. We're actually right about average. I mean, the key thing, again, yes, inflation side, but the unemployment rate currently is 5.4%. That's trending which way? That's trending lower. We're creating close to 1 million jobs a month. So we do not see a 70s style inflation. And why do we have inflation? I talked about some of it. But the concept that, yeah, we're getting back started, right? We shut down, now we're starting up again. So prices are increasing, but will it stick around? Will inflation stay for, say, years, and will it stay at 5, 6, 7%? We do not think so again. We think it might get back down the trend closer to 2.5%, 3% here within 6 months to a year or so. And it's kind of the question of which team are you on? Team transitory. Transitory is one of those words that I think we learned in the SAT, a long time ago. It just means when you're above trend, you're going to eventually go back to trend. Okay, so transitory means you're going to come back to trend. That's where President Biden is. That's where Jerome Powell is on the left there. He's the Fed chairperson. That's where LPL Research has been. We've been in that camp for several months now. On the right, you got Team Trouble coming. You got Larry Summers in the upper right. He's asleep. Someone needs to wake Larry up. And then in the bottom right, Will Dudley used to run the New York Fed. So there are some smart people on both sides of these arguments. There's no doubt about it. But I guess we like to see what is the market telling us. All right, I'm going to get into bond yields and some of the little geekier things, but bond yields are historically low. All right, look at gold. Gold is one of the bigger inflation hedges out there. Gold's like $1,800 an ounce every time I look. All these commodities are up a lot. They've come back. We heard all about lumber being up a ton. Lumber's come back, and then lumber is a supply-demand issue, maybe a little inflation, but a lot of these commodities are coming back as well. So to put a bow on it, we can have a little bit higher inflation. 0.5%. Again, as we get into the next year, 2022, when the truth is our economic growth has been great this year, and I'll get into that, but it's coming back to trend. If economic growth comes back down, which it likely will, that likely means inflation will probably be coming back a little bit as well. So I can answer the other about investment. I mean, mix. Historical stock really well under Democratic. Do really well under Republican president. A lot of gains. A lot of people didn't like President Trump, missed a lot of gains. To us, what's much more important than who's in the White House is the makeup of Congress. And here's what I mean by that. We had a divided Congress, not anymore, right? We had the blue wave, but we had a divided Congress there for a long time. That's split Congress, one side Republican, one side that. That historically is the bullish scenario. Gridlock is good. The last times you've got a split Congress, guys, stocks went up. And again, it's not so much about gridlock is good, you can't get anything done, but it's those checks and balances, not too much power one way or the other. Think back to the election in November. President Biden won. What did the stock market do? Went straight up. Had a huge rally after President Biden won. Is it because President Biden won? Maybe, but it was a little more important to the stock market. We heard a lot about a major blue wave. Do we have a major blue wave? We argued probably not, right? This is the smallest House majority the Democrats have had in 140 years since President Cleveland. 50-50 Senate. Madam Vice President clearly has a tiebreaker. So that's a blue wave. But is it a massive blue wave? No. The market probably was comfortable with that because that's those checks and balances that I was talking about. Some of the more extreme things like adding Puerto Rico as a state, DC as a state, stacking the courts, those are out the window when the election came in closer than people expected, and that likely meant some gridlock. Just look at what's going on with taxes. I know that's another question. I've got some slides on taxes, so I will get to that, I promise. But it's taken a while to get there. Higher taxes are coming. I mean, there's no doubt about that. But again, it's not as easy because, again, the makeup of Washington right now. So to us, the makeup of Washington is important, but also what's very important is the economic cycle. I'm going to talk about the economy very, very soon here. The economy is growing. The economy is young. We're seeing some real impressive growth. To us as investors, if you're early in an economic cycle of growth like we are, because we just got out of a recession about a year ago, that can matter a lot more than whoever's in the White House and the makeup of Congress or any of that stuff, right? If you're growing earnings and the economy is expanding and confidence is growing and animal spirits are out there, that can be really, really powerful. So trust me, we all have our biases, and definitely, politics play a big role in a lot of things. And no doubt about it. Policy, I got a policy section here I'm going to talk about in a minute. So policy matters, but again, to just simply base it on the White House, we would agree with you that there's other things to look at. So do you want to? I can get into more stuff, or you want to ask me another question, or what?
That's great, Ryan. I appreciate you talking on that, and just touching back also on the inflation, and the way I look at it too is, look at this world we live in today. Back in the late 70s, it really didn't matter a whole heck of a lot what was going on in China, and the price competition. And we as the consumers, we have some control over this. We can go onto Amazon and look for the best prices. So does that weigh into it as well?
Great points there. And I probably should have mentioned that, but thank you for reminding me. Our director of research, Mark Zabicki, just put together a piece on this. And he talked about, in our view, the consumer has more power, the US consumer, let's say, has more power than they've ever had. And a lot of it, yeah, it's the thing in our pocket or our purse, right? Our phones. Couple clicks of a button, you can find the cheapest thing out there. That's called deflationary, right? We think the phones are deflationary instruments that really give the consumer a lot of power. And it's also connected to globalization, right? Like you said, we didn't care about China 30, 40 years ago, but now we pay a lot more attention to China and the whole scope of things. So globalization, the Amazon effect, increases in productivity, increases in technology. One of the key concepts of the 70s was stagflation. We talked about it, high inflation, low economic growth, but also low productivity. You look at today, we've got some pretty high productivity. I used a story just 2 weeks ago. I went to Miami for an event, for the first event I got to do with LPL and our advisors in a year and a half, right? And it was in Miami, so we had a Cuban Nights type of theme, right? So you had to dress with white satin and this and that. They told us on like a Friday. I had to fly out on Sunday, and I'm like, really? So I told my wife, she clicks a few buttons on the internet. The very next day, for $42, an entire outfit comes out. You talk about productivity, for $42, that's cheap. It saved me all day running around town, getting mad in Charlotte. I'm running around looking for satin shirts. So anyway, that's just one example of it. But we are so much more productive now than we were in the 70s. And that's another kind of what we call cap on inflation, why we just don't see massive runaway inflation. And again, we had inflation for about 2% for 10 years, from 2010 to 2020. Right, last year, not so much inflation. This year, because of the terrible recession, this year inflation's coming back. So it just makes sense as you get the gears shifting a little bit and moving again. You have a little more inflation early in an economic cycle. If the economy keeps growing, it's okay. And one other thing, wage growth. I mean, okay, inflation's one thing, but people actually make more money now. It's bad when inflation's going up and the wages aren't going up. Now, not everyone's wages are going up, I'm fully aware, but for the most part, wages are going up. Companies are hiring. I just look at LPL. I mean, we're hiring like mad around here, and there's a lot of opportunity for a lot of people to get new jobs and potentially higher paying jobs. So a little bit of inflation with a little bit of wage growth, it's not such a bad thing. Yeah.
Thank you.
Okay. All right. Just want me to jump into it then?
Sure.
All right. So guys, let's just have some fun here. So let's put it in perspective. I kind of cheated and told you about this already. We have 100% rally off of the lows. That's the fastest 100% rally for stocks, at least since World War II. I think in the 30s, maybe there was a bigger bounce out in the Great Depression, but at least since World War II, this is the fastest bull market to double. As you can see on the screen, it's that blue one. It took just over a year. The previous fastest to double ever was over 2 years. That was the last bull market, 2009 and 2010. So let's just put some context around this. Usually you can see on the screen there. Usually takes like 3-4 years, took as long as almost 6 years there for one of those bull markets to double. This one doubled in about 18 months, 17 months to be exact. So that's pretty much off the charts. So again, but what happened before? Well, we know, right? You all lived it and felt it. 34% correction in 6 weeks. So as quickly as we went down, we went higher. That globalization, the way we communicate, we do think, markets are kind of slow and boring right now, but when they have the volatility, it happens fast. And that is, again, about all the communication, right? Our phone buzzes and you kind of know exactly what's happening the second it happens, right? There's more communication now than has ever been. So our take just generally is this is a bull market that's going to continue to go higher, and I'll talk about that. But we have periods where nothing's happening, and the news hits and all the computers, all different things, we can get a lot more volatility. And that's exactly what we saw, last spring, and then in some of the bounce that we've had since then. So it's real important to put the concepts behind how just kind of unique this big bounce has been. And I'll talk soon enough about equities here. But again, just be aware that there's probably going to be a time when stocks actually, heaven forbid, pull back a little bit, right? I mean, hopefully we're all alive long enough for another bear market. We don't see a bear market for a while, but again, we see an opportunity should stocks finally get a little weak. Now, 2020 was pretty bad. I think we all agree there. 2021 was something all by itself. I don't know if you guys remember the Super Bowl at the start of the year. Remember the Super Bowl at the start of the year? Remember the halftime show? People literally had underwear on their faces at the halftime show. And I'm thinking, oh my God, 2020 was horrible. 2021 is going to be a lot worse. The good news is 2021 is really improving, but it is really unique what's happening out there. This is a real thing. An artist sold an invisible sculpture for $18,000. Like, here's my sculpture. You want to buy it? Like, I mean, there's some really, really odd things taking place that's happening. But still, the good news is what's happening, and I'll get into the fundamentals. Earnings are still strong. The economy is coming back. Consumer confidence is taking a little bit of a hit with Delta, and I'll talk about Delta soon too. But overall, there's still a lot of positives, but just be aware it's a little unique. But the really good news is we've made it, right? And I know Delta is not over by any means, but for the most part, we're with all the vaccines and the ways to treat, we are kind of hopefully looking on the other side of things. So we made it. I saw this picture the other day. I thought it was really cool. Doc and Marty from Back to the Future. So it's just neat to think that, we have hopefully made it to the other side and we can continue to grow our economy and our stock market. But there is one real world worry of mine. The fact I am in the office right now. So I'm in Fort Mill, South Carolina, just south of Charlotte, where LPL has a big office. And one of my worries is like nobody's here, right? I'm worried when people start coming back to work after working from home for so long that this might be considered regular business attire because it's what we've been wearing for so long. Anyway, all right, there we go. All right, guys, let's get into it. So Chief Market Strategist, been with LPL for 5.5 years now, moved from Cincinnati, Ohio with my wife and 3 kids. Again, 17 years ago today was the first date with that wife. Pretty weird to think about, honestly. 17 years. It's like, feels like a lifetime, and then it feels like yesterday, doesn't it? Anyway, so 5.5 years. My job's a lot of fun. So I get to do stuff like this. As we mentioned earlier, Liz mentioned in my bio, I get to do some of the media stuff. I've been told I have a face for radio, but they keep throwing me back on TV as well. So I get to do media stuff, but I'm a mouthpiece for a 29-person research team that manages more than $64 billion. So if you see me on TV talking about something on the radio or wherever, I'm talking about our opinion. I'm talking about our research team's opinion of how we see the world, investments, the Fed, inflation, all that stuff. So it's something that we don't take lightly, and it's a lot of fun. Believe me, it's stressful too. I mean, at times, my daughter's 13. She saw me like 2 weeks ago. She looked at me kind of funny. I go, "What's wrong?" She goes, you're looking kind of gray. And I'm like, man, like you try to manage billions of dollars in the middle of a pandemic and a bear market for people. It's, it's stressful, but anyway, it's all right. So let's get into it. You guys remember this guy, Little Hercules? All right. Remember he was like big, no pun intended, 20 years ago. Now the thing about Little Hercules is if you saw him today, he doesn't look anything like this. He talks about how he's got joint issues. He's had actually some growth issues. He did too much too fast. It wasn't his fault. His dad kind of pushed him into it. But I mean, what happened to him at a young age? So just remember the concept of doing too much too fast, growing too soon. So let's go forward for a second. Robert Wadlow, tallest human being to ever live, almost 9 foot tall. You see him there, pituitary issues, looks like a superhuman. Sad thing about Robert Wadlow, he died at 23 years old. He literally he had an infection, and he broke a leg and the bone was sticking out and got an infection and died. He couldn't even walk like the last year of his life. Really, really sad. So again, too much, too fast. So remember those concepts. Now let's talk about the stock market. So this is a big picture view on where we see the stock market. You guys, I'm going to talk for a second about the idea of a secular bull market. A secular bull market is simply when stocks go up for a decade or more for the most part. Secular bear market is just like it sounds, when stocks struggle for many, many years in a row. So the first shaded area on the left is one of the first secular bull markets since the Great Depression, 1950 to 1968. For 18 years, stocks mainly went higher. Did they go up every year? Absolutely not. You've all heard of the 7-year itch, right? 7 years into a relationship, a car, a job, whatever it is. You might get a little tired of something. It's scientifically proven. It's the way our brains are wired. But the 7-year itch struck in the stock market. 1957, you see a little shaded or the little circle area there. It doesn't look like much because this is a log scale chart. That was a pretty big pullback. There was a recession and a bear market in 1957. What happened after that though? For 11 years after the 7-year itch, stocks went higher. Remember what Mark Twain told us, history doesn't repeat itself, but it often rhymes. Remember that. Then you had the 70s. We've talked about the 70s already a little bit with inflation. Terrible time for investments. Stock market didn't do anything for like a whole decade. That's a bear market, secular bear market. Then we had a secular bull market. 1980, the S&P finally broke out the new highs, right? Terrible, inflation still high, lots of bad things, but the stock market was sniffing out better times ahead. That led to the huge explosion in growth and earnings of the 80s and 90s, the 80s and 90s bull market. Guys, add 7 to 1980, and what do you get? 87. The 7-year itch struck again. History repeated itself. 34% correction, fastest bear market ever, fastest 30% correction ever until March of 2020. But after the correction in 87, stocks went up for 13 more years until 2000. From 2000 to 2013, check it out on your screen there, stocks went nowhere. Guys, the 2000s, that decade was worse for investments from a stocks point of view than the 30s, all right? So we planted some pretty big roots. The fact that we suffered as much as we did from an investments point of view for 13 years, that was the pain that you have. That's the price you got to pay for admission sometimes in major secular bull markets to get there. We had some pain with 250% corrections, the tech bubble early in the decade and the financial crisis later in the decade, as we all remember. But in 2013, I think it was April of 2013, a funny thing happened. The stock market broke out to new highs. I remember specifically during that time, a lot of people were still very, very, very bearish. I made a name for myself as a strategist at a small shop in Cincinnati. We were one of the few bullish places. I went on TV all the time in 13, 14, saying why we thought this is a major new bull market and stocks are going higher. And sure enough, that's exactly what happened. Now add 7 to 2013, and what do you get? 2020. LPL Research had no idea the 7-year itch is going to take place like that, but it did, right? And now that the 7-year itch is over, we could have many, many more years of an equity bull market, in our opinion, a major structural bull market. So these are some big concepts I wanted to build a little bit of time on. Again, if you look back at history, let me see. So you remember Pavlov and Pavlov's dogs, right? Remember, you ring the bell and the little dogs start to slobber because it means they're going to eat. I do the exact same thing when people tell me it's time to eat. So I'm not judging those dogs at all. But there was a horrible flood in Leningrad, and tragically, 1920s, a lot of the dogs drowned. But what happened after the flood, Pavlov started up his experiments again. He started ringing the bell. And you know what happened? The dogs did not slobber. So Pavlov determined, rightfully so, 100 years later, we still agree with it, that during times of stress, during times of extreme fear, during times of unknown and uncertainty, our brains short fuse. Our brains stop working the way they're designed to. And it's not our fault, right? It's the way we're designed. There's nothing we care about more than our family and our money. I mean, there may be something else out there, but for the most part, your family and your money are two things we're all very, very connected to. And in the middle of a horrible pandemic, your family and your money are two things that maybe are struggling and you're worried. So just kind of remember that we're going to have pullbacks. The market's going to be scary. That's why I'm so honored, to be here today, with Margie and Liz and the team to help you guys. You guys are in very, very good hands because honestly, sometimes you need someone to help you make those investment decisions to get you to the other side, to get you to your long-term investment goals, because it's just the way we're wired. Everyone says, I want to buy the next pullback in the stock market. You know what happens 9 times out of 10 if you're just doing it on your own? Everything's petrifying. You got guys on CNBC talking about the end of the world coming on an 8% correction, whatever. I'm just throwing out numbers. And then you kind of, I'm not going to do it. I'm not going to do it. And then sure enough, the market keeps going up. So that's why it's really important to have a plan in place before the next time you have, some rain clouds, right? The time to hunker down is not in the middle of the eye of the storm. It's before the eye of storm gets there. And that's why, I'm honored to be here. Hopefully you guys can work with Margie and Liz and the team that you get your plans in place when we have those rocky times ahead, because
and you're so spot on there, Ryan. And
go ahead.
Liz and I have been pulling up that 2020 chart every review period, looking at that March downturn and reminding our clients, like, okay, if you even thought about getting out and you did that at the top before that March 13th, I call it the Friday the 13th chart.
Yeah.
And then you're trying to make a decision when to get back in. It's not going to happen.
Right.
And exactly as you laid it out there, we have a plan in place for the what ifs. We sure didn't know a 100-year pandemic was going to hit.
Nope.
But we knew something always does. And it's usually something not even on our radar. So we've got to have that plan for the good days, the bad days, and and plan accordingly. So
Yep.
thanks for that reminder.
No, absolutely. So I love this quote by Regis. He said, "I'm involved in the stock market, which is fun and sometimes very painful." I've seen a lot of stock market quotes. I use a lot of them. I think that sums up more than anything. When everything's going great, it's great. I'm happy. I don't, whatever. Look at my 401k statement. Everybody's in a good mood. Look at your retirement statements, whatever statements. And then when the, what hits the fan, it's very, very painful. But that's the price of admission. Lawrence of Arabia, really cool movie. There was a candle, and the one big guy took the candle and pinched it out. All right. And the other guy saw it and goes, "That's pretty neat." He goes up to a candle, tries to pinch out the candle. You know what he did? Screamed in pain. He goes, "How did you do that? How did you not react when you pinched out the candle?" The first guy goes, "You just got to know it's going to hurt." That's investing. I mean, that's honestly like Liz was just talking about I'm sorry. That's what we just talked about there, Margie, with you got to know it's going to hurt. It's going to hurt. And that's just the price of admission. This is a cool chart. And maybe you've shared this one before. The longer our time frame, the more likely you are to have positive returns on stocks. And this is just, things that, are important to remember when things get rough. Every one day you're up about 50% of the time, stock market, 52%. But you see, the longer your horizon, the more likely you are to have positive returns. They say the stock market's the only place things go on sale, that everybody runs out of the store screaming. I really think there's some truth to that. And it's just really interesting about our time frames. And just think, if you have a 10, 15% correction, those numbers I'm showing you go astronomically higher, right? So just kind of remember these things for when the rough times come. But we're going to get into it right now with another favorite quote of mine. "I look to the future because that's where I'm going to spend the rest of my life." George Burns. So this is the Midyear Outlook 2021. We titled it "Picking Up Speed." This came out a little bit after July 4th. Now, the big concepts I'm going to talk about, trust me, the world's changed a little bit, since July 4th, not a ton. So I've got some more up-to-date charts and things in here. But just the idea of picking up speed isn't that the truth, right? We started talking about this Midyear Outlook back in April, and the economy and the stock market, things have really, really picked up speed. But you think about speed in general, it's a good thing, right? You get you where you're going faster, but sometimes it's not always good. Remember the Tour de France with the woman that had the cardboard sign out and she clipped one of the bikes, then all the bikes wrecked. Remember those pictures, that spectacular crash? That was because there's too much speed, right? You're driving, you hit a soft spot or a wet spot, and you slide. Sometimes speed is good. We're not minimizing it. But sometimes too much speed can be bad. So just remember those concepts. But turning to the economy for a couple minutes, and we already talked about inflation, so that's a big part of my economic discussion, so that's fine. The economy this year is growing. We see the economy growing at 6.5%. You can see United States there, and then on the right, 2021 current. What in the world does that mean? 6.5% GDP. Well, guys, that would be the best year of economic growth in the U.S. since 1984. And there's a chance we get a little bit better economic growth. We might have the best year since 1953. All right, that's a long time. Now, full disclosure, last year GDP was down 3.5% for the worst year since the Great Depression. But it really is amazing at how much the economy has recovered here in the United States. And I'll just very briefly touch on the concept of seeing where it says emerging markets. A lot of that is China, but historically, emerging markets grow more than the U.S. during good times and go down more during bad times. They're just, hyperspace, if you will, in terms of movement. We're going to see more growth this year, in all likelihood, in the U.S. and emerging markets. That's pretty amazing. And honestly, just 6 months ago, no one really saw that. We've seen just such incredible growth in the U.S. just the last 6 months, let alone, off of the low. So really interesting concepts from how strong the U.S. is doing. One other concept I want to point out here is the fact that this economic cycle of growth is young. I know it doesn't feel like it. We feel like we've gone through so much lately. But what I'm showing here are all the cycles of growth. You can see the last 8 years, 10 years, 6 years, 11 years. So this is without a recession, right? We're more of a developed country now. You should look back in the 1860s, 70s, and 80s and 90s. The U.S. had like a major pandemic or a run on the banks like every year or two. All right, we were young, we were growing. Now we're more developed, like a cruise ship. Once you get moving, it takes a while to slow down. You're going to move for a while. So we think this economic cycle of growth can go for several more years. And if we have several more years of economic growth, what's that mean? Well, probably means earnings are increasing. It probably usually means the stock market's doing pretty well. It's when you have recessions and trouble on the horizon, or before recession, the stock market sometimes sniffs that out. That's when trouble comes. Just be aware, this is a young cycle of growth. Now, I like to use this joke. You maybe heard of it. See the old line there? That's the average cycle of growth, just over 5 years. We think we can get there. We think we can get to about 5 years average growth. But there's the old joke about the statistician put his head in a bucket of ice and his feet in the oven. Say, how do you feel? He goes, well, on average, I feel pretty good. That's a good joke about averages there. So I talked about inflation. Just one more, then we'll move forward. I kind of talked about this. This is the growth expectations from the start of the year until just recently. Look at the United States. Right, we were supposed to have 4% GDP. Now we're looking at like 6.5% GDP, or over 6% GDP growth. Other parts of the world have increased, yes, but Eurozone and Japan have actually decreased as COVID and issues like that have really hit those countries hard. So it's just really impressive, in our view at least, at how strong the U.S. economy and how resilient the U.S. economy has been. Just some big names you all know and love and use. I mean, Target just last week said, really strong earnings. People are in the store. Best Buy came out yesterday. Really strong earnings. People in the store. Dick's Sporting Goods, really strong earnings. People are in their stores or online shopping. So, the people there are pockets. Clearly, the economy's not perfect. I don't want to make it sound like it's perfect, but there are really parts coming back. And this economic recovery is a big reason why stocks are flirting with all-time highs. So, let me see. I'm going to skip the inflation stuff because we talked about that. We'll just spend a minute.
Before we come
Go
off
ahead.
of that, I know that's one of the stats that you all follow, and I think it's called like the beat. It's like 85% of earnings for beating.
Here we go.
Oh, there we go.
Yeah, so this. I've got this in the stocks part, but we can do it now because you're exactly right. I hinted at it. Just you think about stock market all-time high. Well, it's up 100% from the lows. Is it justified? I mean, there's a logical question. Is it justified? Is it all because the Fed is printing money? We would say no, not at all, because earnings are at an all-time high. And this is exactly what you're talking about here, Margie. 86% of companies beat on earnings. 88% of companies beat on revenue. Earnings growth in the second quarter, as you can see on the right-hand side there, up 90%. This time a month ago, most people expected 65% year-over-year earnings growth. What corporate America did, what consumers did, what we did was so impressive. And in our view, it justifies stocks here. Think about this one. The S&P is up like 19% for the year. Earnings estimates from the start of the year to right now are up like 21%. What in the world does that mean? Well, if you thought stocks were expensive at the start of the year, they're actually cheaper now because earnings estimates are up more than the S&P 500. So earnings drive long-term stock gains. It's amazing every quarter where these earnings keep coming in. And I get it. People say, well, is it just the game that's played, right? Don't analysts lowball it and you come in a little higher? Yes, historically, that is very factual. But the earnings beats that we're seeing, it's really mind-boggling, I think, for a lot of people. And again, that's justifying, in our view, why stocks are flirting with all-time highs, like as we speak. So we'll spend just a minute on policy here. Policies like what the Fed's up to, right? What the government's up to. And I know the taxes, we're gonna get the taxes here because it's a very popular question, or maybe unpopular question, but a very a common question that I do receive. So higher taxes are likely coming. There's a lot of spending that's going on out there. We know that. Likely the higher taxes are going to be on the wealthy and on businesses. And likelihood it's not going to impact most people, but the higher income and then corporations, yeah, they're probably going to be paying higher taxes as of now. As a percent of GDP, as you can see here, we're going to see one of the GDP, by the way, is just your economy, right? What your economy is growing. We're going to see likely one of the largest jumps in taxes we've ever seen. And honestly, I've mentioned it with inflation, like is the market really surprised by inflation? I mean, the answer is no, because we're making like new all-time highs. Is the market really surprised that higher taxes and more regulation are coming? We don't think so, right? President Biden ran on that. I mean, the stock market rallied like mad after the election, like I talked about, and it kind of knew there was likely higher regulation, higher taxes coming. That's just what President Biden ran on. So it's in there. But are higher taxes bad? This is the question I know you guys are asking. We would say it depends. Not a perfect answer. But here's what I'm showing. Higher capital gains. This is the previous times we have higher capital gains taxes, and we're likely going to have higher capital gains taxes here sooner than later. 69 and 76, check it out. 6 months to a year later, what happened? You see some red, some underperformance, no doubt. Remember, we talked about the 70s was a horrible time for investments, though, right? The economy wasn't doing that great, a horrible time for investments. 86 and 2013, higher capital gains. What happened? Look, 6 months later to a year later, pretty strong. All right. Those were or 86. You had a young economic cycle of growth. 2013, young economic cycle of growth with an accommodative Fed. Sounds kind of familiar to right now, up 25% a year later. So we're not minimizing higher taxes, more regulation, higher cap gains. What we are saying is a lot of that's been priced in. And what matters more, and this is what this chart, in our opinion, shows, is the economic cycle. And if you have some Fed accommodation, maybe how old the cycle is, those matter more than just about anything, right? And we can withstand probably higher taxes in our view. And this is one way to show it. Now, the Fed is the other part. That's the government, right? We know the government's pulling a lot of levers, but the Fed isn't going anywhere. You all heard Jerome Powell before. This is the Fed balance sheet. When you hear the Fed is printing money, this is what it's kind of what they mean. The Fed is buying up bonds, $120 billion worth of bonds every single month. The Fed balance sheet continues to grow up over $8 trillion. And I get it. Why is the Fed not audited? Why does the president pick who's in charge of the Fed? I mean, these are some logical questions that I don't disagree with, but as a steward of assets, what we know is during the 2010s, that last decade, when the Fed expanded its balance sheet and kept interest rates low, what happened? Stocks did great. Did the economy do that well? You could argue no. We had like 2% inflation or 2% GDP growth most of those years. But what the Fed did was try to create confidence and liquidity. They're doing that again. Guys, LPL Research was the only broker-dealer to upgrade our view on equities the last week of March 2020. I guarantee you it was scary. It was like one of my calls. I mean, I hit like send on the email from under the desk while hiding because I sent it because that was pretty scary time. But we saw some potential positives. We said, what if the comet misses one more time? Right? What if the Fed comes in and backstops everything, which they did on March 23rd? Then we upgraded our view on equities on March 26th, added some equity risk in the midst of a horrible time. But it turned out to be a really good investment decision. And really, in the 5.5 years I've been here, it's by far the most proud I am about anything I've done. So we really impacted people by using that pullback as an opportunity, not a time to panic. And a big reason why, because the Fed, it is what it is. The Fed was a backstop and brought back confidence. So the Fed is still a tailwind in our view. They're not going anywhere.
So Ryan, I'll just pause you right there since you're talking about the Fed, and of course Jackson Hole is
tomorrow.
Well, now virtual. That's interesting. And just this whole tapering concept. And I mean, to me, it doesn't sound like even when they start, it's just going to be so incremental and not big. So if you could just, whether here or later, just talk to that.
Yeah, I mean, so just so you guys know, Jackson Hole is the annual symposium put on by the Kansas City Fed every year in Jackson Hole, Wyoming. And it was virtual last year until Friday of last week. It was in person. All right. And just on Friday afternoon, they said, okay, it's virtual now. You know what the market did like the next 3 or 4 days? Rallied like mad because people said, wow, if the Fed is canceling their own meeting because of Delta concerns, they must mean the rest of the economy may be a little shaky, at least in the near term, which makes sense, So the Fed will still be accommodative. So the market actually rallied when the Fed went more virtual. So that's just kind of one thing to think about. But the whole idea of tapering. So I mentioned the Fed's buying $120 billion worth of bonds a month. Tapering simply means they're going to start buying less, right? And the wide assumption is likely later this year or maybe early next year, the Fed will start to taper. Instead of buying $120 billion a month, maybe they buy 105, maybe they buy 100 billion. But it is like you said, Margie, it is going to take years for this tapering to take place. You're going to hear a lot about how there was a tapering tantrum when the first hints of tapering in 2013 happened. And it's true, the bond market was rocked pretty hard because of the tapering tantrum. You know what stocks did in 2013? They pulled back 6%. And then rallied like 30% for the year. So stocks took the tapering in just fine in 2013, 2014. So you're going to hear a lot of worry about it. But what the Fed is scared is if they do the tapering and then yields spike up. Remember, if yields go up, bond prices go down. Bonds got hit really hard in 2013. They don't want to do that again. They don't want to catch people off guard. So the Fed's been telegraphing this, my opinion. Jerome Powell's on 60 Minutes like every other month, all right? He's been telegraphing a lot of what they're doing. So we don't think it's going to catch the market off guard. Doesn't mean you can have some volatility for a little bit, but again, tapering's coming, likely higher interest rates are coming, likely higher yields are coming, more regulation, more taxes, all these things are likely coming. But again, it shouldn't come as in our view, at least, too big of a surprise. Speaking of surprises and secrets, it's not me who can't keep a secret. It's the people I tell who can't. Honest Abe Lincoln. I don't know if that's a real picture of Abe or not, but I do like his glasses. So I didn't know this is a secret. The amount of, so we just talked about monetary policy, fiscal policy. That is the government, right? The levers the government pulls. Think the CARES Act and the coming infrastructure coming as well. The orange is now, the blue is. All you got to know is the amount of fiscal system now versus the financial crisis is astronomically higher, and those, in the future are going to go up because of the infrastructure plan, which likely will be passed later this year sometime. That'll add to those numbers, and those are going to go out for like 8 years, I believe. So there is still more spending, and I get it. People say, well, the government's just spending a bunch of money. It's true. I mean, they are. They kind of have to, right? But it's not all about just spending. I mean, these infrastructure plans potentially can increase productivity and help people. So there's some reasons behind it. And the truth, guys, here's the truth. Again, as a steward of assets, we just go with what's the truth. The truth is stock markets don't mind spending. All right? They kind of like spending. So with all the spending coming with an accommodative Fed, with an improving economy that's still young, all these things kind of massaged together suggest again that this bull market has a good amount of time left to it. So let me just see. We'll go. Okay, here's a funny one. Speaking of truth, secrets and lies. First off, any Seinfeld fans on the call? I don't know. Margie, you like Seinfeld? You're a Seinfeld fan?
Takes me back to college days, actually.
Yeah, well, let's always remember what George told us. It's not a lie if you believe it. Anyway, all right, let's do stocks and bonds and we'll wrap this up. So stocks, we said gaining ground. I mean, isn't that the truth? I mean, like I said, over 50 all-time highs already this year, which is just amazing. The all-time record, by the way, for highs in 1 year was 77 S&P 500 new highs in 1995, one of the most bullish years in history, 1995. We're on pace to hit about 77 or 78 new all-time highs. Doesn't mean we're going to get there. In fact, if you put a gun to my head or whatever, I'd say we probably don't. I think we might have a little more consolidation in the second half of this year, but it's still been a great year, don't get me wrong. But it's just amazing, again, at how much strength that we've had. So Neil Ferguson said, the dead outnumber the living 14-1. Ignore such accumulated experience at your peril. There's a lot we can learn from history, as you kind of gather. The way I look at the world, I like to look at the past to get a potential path for the future. Churchill said, the further back into the past I look, the further into the future I can see. I think I like that one. But what about the future? What about the past? Guys, we're in the middle of a 6-month win streak on the S&P 500. Well, I know there's a lot of numbers on here, but these are all the longest monthly win streaks on the S&P 500 that hit 6 months in a row. What happens after is what I really want to focus on. Look at where it says 12 months later. Do you see much red on there? I don't. We haven't had a year after a 6-month win streak negative since, 1980, all right, early 80s. The average is about 12% a year after a 6-month win streak, all right? The average year gains like 8.5%. So what I'm getting at, is the strength that we've seen. I know it sounds kind of counterintuitive, but the strength we've seen recently, the persistent buying and strength, it tends to resolve higher. Things can change, we're aware, but it's just another way to look at the future could be pretty bright for equity investors still going forward. So here's our views on the S&P 500. We have a fair value target up around 4,700 there. S&P just keeps going up. I'm fully aware. I'm a strategist that hates targets. I think we're in a major structural bull market, like I talked about in the 7-year itch slide. So yeah, we've had to upgrade that a little bit. We see earnings up to like 40% earnings growth this year. Spectacular. And we'll talk about yields in a minute or two when I get to bonds. I might have to skip a couple here just to do in a little bit. Don't ever judge a book by its cover. Anyone want to take a guess? Margie, you want me to guess who that could be? You want to take a wild guess? Put you on the spot.
Oh, geez. Mark Twain again?
No. No, that is Tom Brady right there. So, if you see that, you would never assume he's a 10-time Super Bowl participant, 7-time Super Bowl winner. Don't judge a book by its cover, which leads us to year 2 of a bull market. Do not judge a book by its cover. Guys, year two, I heard so many people, year two, by the way, started back on March 23rd of this year, because year one of the bull market was March 23rd of 2020. For the first year, stocks gained, up over almost 70% or so, you can see there. But year two, people are like, oh my goodness, if we up all this in year one, year two has to come back. It has to be bearish. Not at all. Year two of an economic cycle, or sorry, year two of a bull market has never been lower since World War II, and I'm showing you all of them right there. So up about 13% on average. We've actually probably up well over 13% just since the lows back on since March this year. But again, it's a key concept that young in an economic cycle of growth, you tend to have continued strength. So really, really powerful concept. One we've been sharing a lot. We've got a blog, lplresearch.com. I have a podcast, LPL Market Signals, a weekly podcast. It's the podcast. We talk about these concepts every week right there. So we've been putting out there a lot. Unfortunately, it's been working. Now, 100% rally, do not ignore the fact that it is the calendar could be a worrisome sign. And this is one of those that is what it is. September, guys, historically is the worst month of the year. August isn't all that great either. Yet, forget about it. This August, we're just going straight up. I'm fully aware. We're probably going to be up 7 months in a row when August is over. But still, just don't ignore the fact that it's going to be a little troublesome, kind of banana peel month. Last year, we had an almost 10% correction intra-month during September. I do this for a living. I have no idea why. All right, I don't remember. I don't remember. Maybe because we're up so much off the lows and this normal pullback. Whatever the reason, we might have some potential volatility. We've got the Fed coming up. We've got another Fed meeting in September. September is when people get back to school. And hopefully get back to school. People done with the summer. It's when a lot of hedge funds years are over in September fiscal year. So sometimes squirrely things happen, whatever the reason. And I don't pretend to know why. I just know September can be a weak month. So just be aware of that kind of as we reach into these troublesome months. And that brings up October. October gets a bad rap. For some spectacular crashes. Usually it's pretty strong month, but it is one of the more volatile months. So just kind of be aware of those things. A couple more slides on this and we'll get the bonds and wrap it up. One of our bigger concerns is stocks aren't cheap. This is a PE multiple. Keep this pretty simple. Price to earnings. You're paying for earnings in essence when you buy a stock or buy the S&P 500. You're paying for those earnings. People are paying up, right? And why is that? Our view is this: stocks are expensive. Bonds are really expensive with yields as low as they are. And with inflation, I know inflation's high now, but inflation overall has still been relatively low for years. So with low inflation, low yields, it makes sense to us that people are paying a little bit of a premium for stocks. And we've been saying for a while, it's a concern, yes, but not a reason to be, hiding in cash under your bed. And we still feel that way. Just because stocks are a little pricier here, earnings growth is coming in so much faster, it helps justify it. But you don't believe it, it is a potential concern. Let's just do bonds and we'll wrap this up. So safety features. We came into this year at LPL Research saying this: stocks would do a lot better than bonds. The portfolios, the billions of dollars we run for our advisors and their clients, we were overweight stocks, underweight bonds. That's worked out pretty nicely, to put it mildly, so far this year, as bonds are virtually flat on the year with stocks up, 15, 10, 20%, some up a lot more. And we still feel like stocks will probably do a little bit better than bonds, but that does not mean you shouldn't have some bonds in a well-diversified portfolio. We call safety features, right? I say it like this: stocks tend to outperform bonds on a long-term basis. Most people are aware of that. But what do bonds do? They help you sleep at night. They help you stay in your stocks. If you're just in all these meme stocks and then they crash, you're probably going to want to sell. But if you got a well-diversified portfolio that you use with Liz and Margie, and then when you have sleepless nights like a March of 2020, let's hope we don't have another March of 2020, but let's say a 10% correction on the S&P, which again, wouldn't be too abnormal after 100% rally. If you have some bond exposure, it's probably going to help you sleep at night. So bonds, I just added this, let me know if you think it's funny. Bonds have been bad and always be worse. It always. This is a little geeky, and then we're going to wrap it up. But the idea that if copper is doing well relative to gold, think about copper, an industrial metal. If the economy is doing well, people are going to buy more industrial metals. If gold is doing well, that's a precious metal. Probably means trouble's on the horizon. It's never quite that black and white, I'm aware. But for the most part, it is. What I'm showing here is when copper outperforms gold, like we've been seeing a good chunk of this year, that usually means the 10-year yield. Remember, if yields go up, bond prices go down. You can see it on the screen there, pretty big surge in yields lately. Now it's pulled back a little bit. Don't go question about it lately, but for the most part, yields are higher. That's impacted bond prices. We still see higher yields the rest of this year. Probably impact bond prices. If you have higher yields, what we're doing in our models that we run, I can be a little geeky on you, but we're shortening up duration. We're not buying long-term treasuries. Long-term is impacted more when yields go higher. We look at mortgage-backed securities. They're a relatively cheap area in fixed income. Bank loans and sticking with high quality are some of the areas we're focusing on bonds. But just big picture, again, we still think stocks are going to do a little bit better than bonds. But here's a cool quote by Peter Bernstein: diversification is the only rational deployment of our ignorance. Read a lot of his books. Peter talks like that, but simply meaning stay diversified. Work with Margie, work with Liz. Don't get too lopsided one way or the other. Just do what they tell you, really. But I mean, they'll make sure you don't get too lopsided one way or the other. But staying diversified helps us sleep at night, reaching our long-term goals, not panicking when we have a big market sell-off, because those bonds actually help us. And you look at the end of the day, oh, okay, well, I'm down, but my bonds did okay. That helps you reach your long-term goals. And the last chart I'm going to share is this one. What happens when bad months take place? This is all the bad months we've seen on the S&P the last 20 years. That's that blue line that goes down, all right? What do bonds do? That's the Barclays Treasury Index there, the teal color on the top, on most of the time on the top. Well, not too surprisingly, with some of the worst months stocks have had the last 20 years, bonds did really good, right? And again, we'd still say stocks over bonds here. But again, that's why you still want to have some bond exposure, some fixed income exposure, maybe some cash, maybe some gold if it works for you. You work with Margie and Liz and the team. But still, having some bond exposure helps you withstand the inevitable pullbacks. Remember, I said it's going to be painful. Like you clip when you pinch out the candle, it's going to be painful when it happens, but that can alleviate the pain.
Yeah, Ryan, I'll just touch on that. What Liz and I say all the time on the bond allocation, that depending on age, risk tolerance, and those various factors. But here we are on the cusp of college football. Looking forward to some good Navy games here in Annapolis. I think you're an OSU fan, if I'm not mistaken.
Yes, I am. I'm an Ohio boy. You kind of have to be an Ohio State fan, unfortunately or fortunately. But yes, Scarlet
and the Gray, right? And Liz being her Clemson self. But we do say, okay, fine, we're going to that sporting event. There's some clouds out there. Let's take the umbrella just in case.
Yeah. No.
That's our bond analogy.
I like it. That makes, assuming they didn't let you take an umbrella to a game, maybe a poncho, right? I don't know. Yeah, I hear you.
That's true. Totally, we can't take umbrellas anymore. That's right.
Yeah, I hear you. And by the way, so as an Ohio State fan, moving to like South Carolina, I mean, I'm in Charlotte.
So you're surrounded by us.
Oh my goodness, yeah. And when they whooped us there a couple times in a row, it was miserable. But we got them last year. Now that we go play Bama and got hammered by Bama. But you know what? At least we beat Clemson. But anyway, so that's another good thing about what's going on. But the last slide, guys, the last thing I want to talk about, and then I'm done. Thank you again for having me. And we got a little more time for Q&A if you want to. But let's not forget how lucky we are. So Harvard did a study. The odds of being born are 1 in 400 trillion with the T, trillion. That's like mom meets dad, grandma, grandpa, all the wars, famines, horrible things have happened for thousands of years. We're born, all right? Then the fact that we're born in the richest, safest country in the world is just, a cherry on top. But to put the perspective around what is 400 trillion, if you had one dolphin in the entire world, the 5 oceans, and you told them swim around, and you took one of those circular lifesavers you see in a boat, you throw out to save someone when they're drowning, you take that lifesaver, throw it in the water, and that dolphin's under the water in any of the oceans in the world, and he pops his head up, that is approximately 1 in 400 trillion. Those are the odds of being born. So trust me, we all have good days, we all have bad days, with this and that. It's important, I think, to remember that, hey, we've got a stock market at all-time highs. That's good. But without our health, none of this stuff matters. So hopefully everyone stays healthy. Let's remember how fortunate and lucky we are. I'm lucky to spend the last hour with you guys. I'm honored you guys invited me. And I've got a few more minutes if there's any more questions. But thank you so much. And I'll end it with this. Everyone on this call, is in very good hands. It's going to be scary when we have that pullback, but just the fact, that Margie and Liz reach out and ask me to come and do this, it shows, they're forward thinking. They're there for you, right? I worked with a lot of advisors. When March 2020 hit, not all advisors were there for you. And again, I know that wasn't the case with you guys, because when the scary times happen, they step up and are there for you. So you're in really good hands. If anything LPL Research or I can do, I'm just an email, text, direct message on Twitter, whatever you need. I'm there, but I'm honored you guys had me. And here's to a continuation of the bull market, good economy, and getting through COVID and staying healthy. So yes, thank you. I'll go to your last slide here. Just so there we go. Boom. There it is.
Time, Ryan, and for everybody who attended today. And you can always send us an email. We've got Debbie's information on there, and please feel free to reach out to us and we'll be sure to follow up with you. So I guess with that, I have one dog joke for you, Ryan.
Oh boy, good. Let's hear it. I
actually had many, but I'm just going to throw one at you. I think you can get, and let's just do this. What dog keeps the best time?
What dog keeps the best time? I don't know.
A watchdog.
That's good. That's good. I like it.
All right.
Everybody can hear that one.
Awesome.
All right.
Hey, thank you so much.
Everybody, thank you.
Thank
Bye-bye.
you. Bye-bye.